Zach, here is the thing. So Danny's out this week, and
Yes.
which usually means we're going to have the best show ever. Danny won't believe it, but on the morning call with Danny today, he said to us, "Good luck." Like he was kind of lingering. Don, back me up on this. He was kind of lingering on the morning call this morning, and he's like, "Hey, maybe it might be a little harder." I asked Don and Don and Hunter to be a little bit more active, uh, and finally, like after like 15 seconds of Danny just talking about this, like how he's not going to be on the show with something that we already know, I finally said, "Oh, wait a minute! You want us to miss you? I got you. I'm going to go get a Jesus candle, light it in your honor, put it right where you would sit, and we'll just burn it all show, letting
really?
as a representative that we miss Danny."
That's
And
right.
I immediately started just shuddering in fear at the thought that Danny wasn't going to be on the show. I mean,
that's what Danny wanted to hear.
How are we going to overcome that?
Yeah,
He doesn't remember that one of our best shows were the last time he wasn't on when I imitated his closing, which I will be glad
you have to do again.
Yes.
Today.
And that's the thing. So Danny, we miss you. We know you're only going to listen to the first 30 seconds to see if we mention your name, and then you'll shut the show off. So
we're here for you, Danny.
I will say this with Danny not being here, we do have a new podcast character.
Do we?
That's going to be on here, Tim. Yeah, I know you can't see, but check your phone. I just sent a picture of him. This is Timmy Bear.
Oh, that's awesome!
Who is that?
I do actually have it. Yeah, that's funny.
My gosh.
That is funny. I like Timmy Bear, man.
So Timmy Bear he's Yogi's cousin. He rails against half-empty picnic baskets, not half full, half empty.
There you go.
Picnic baskets. So and he also this is weird. Little backstory on this. This stuffed animal is about 40 years old. It was actually my wife's sister-in-law's.
That does not look like a 40-year-old.
I was gonna say, I look new.
No, it doesn't.
Yeah. Listen, yeah, I know. And the weird thing is, it looks like a bear, but it has a tail. So we have actually no idea what kind of animal this actually
what it is,
because it's clearly not a monkey.
Yeah,
it's not a monkey.
It's a cross.
It's the so we call it monkey bear, and he has
hybrid.
My granddaughters call it monkey bear. Do.
Does anybody remember Shirt Tails?
Shirt Tails.
Shirt Tails.
Yes.
See, somebody remembers Shirt Tails. Google it at home. So here's the thing. I had a whole show planned out, knowing Danny wouldn't be here because Danny really I was going to talk about currencies and stuff, but I'm like, let me save that for Danny. So I wrote a whole nother show out this week, knowing he wouldn't be here, and then we got listener mail.
Oh,
I love listener mail. I get a ton of direct messages on Twitter at TJ Razors, where you find me, or email.
Now's a great chance. If people do want to write on the show, how do they do that?
Oh, you know what? Let me just pull that up right quick.
Second.
Yeah, if you want to write to anybody on the show, that's a great. That's why you're the executive producer.
I'm here for you, Tim.
Yeah. So at Tim at Revere Asset, Don at Revere Asset, Hunter at Revere Asset,
and right into the show.
Alex at Revere Asset. If you want to complain or tell Danny how the candle in his honor was beautiful, Dan at revereasset.com. So anyway, someone wrote in and they asked a really good question. And I'm like, I'll just call Hunter on my way in and I'll ask him to put together some thoughts on this topic. And then I'm talking to Hunter, and this is the beauty of collaborating with people. I then realized what we should be doing this show. Oh. So I'll read the question to you, okay? Because what it's going to do is introduce a whole new way. Hunter, I've devised a strategy that I think I'm going to start doing based on our conversation this morning. And so let me read the question to you, and that'll set it up. I want to address his name's Cody. I want to address Cody's question first because that's fair. And then I'm going to go into this whole other way that I want to invest. And I'm not going to promise you that I'm not going to jump around. So here we go.
Go for it.
Hey, Tim, I got turned on to you guys during COVID. Really not sure how. I think someone from Omaha tweeted something you posted. I really enjoy listening to your show and videos and your methodology. Quick question. Do you know if any of the videos you have touched on PSTH, which is Bill Ackman's SPAC, that's the ticker symbol PSTH. And if you're listening at home and I'm talking too fast, Papa Sierra Tango Hotel is the ticker symbol there, spelled phonetically. I've owned it for a while, and I'm curious to hear your guys' thoughts on it, on the deal that you're doing. And the deal that you're doing, that Bill Ackman's doing, is with Universal Music. We'll get into that in a second. So we're going to address that, okay?
All
So I'm already audibling.
No, yeah.
Because what I want people to stick around for is the answer to this question, which is a really good question that Hunter's going to start out with. But then I started thinking, like, what if we bought every SPAC? So last year there were 220 SPACs, I believe. There were a lot of SPACs.
Yeah.
Like special purpose acquisition corporations. They're the old new thing.
Okay. The old new thing.
The old new thing.
Yeah.
And then I got to, from there, I'm talking with Hunter, and I thought, wait a minute. What if we just bought every IPO? What if we put $100 or, Alex, you know this, right? Like the fantasies of if you just put $10,000 in Amazon, everyone's seen that, right?
Yeah.
Like that's the whole allure of options, right? Like if you just bought out of the money calls in GME and they explode, and that's the whole attraction. It's the lottery ticket mentality. That's why lotteries exist, That's why old people go play bingo on a Wednesday night,
Yeah.
So and there's nothing wrong with it. It's just that's just the way the human psyche works and why it often works against you when you're trading or investing. But I thought there's got to be something there. And hear me out. And Don, I said to Hunter, I think this is the antithesis of what Don would want to do, but I'm not sure. So when you disagree, pipe up. Think about. I'm putting this out there now so you can think about your thoughts. Think about your thoughts. Is that something?
I always think about my thoughts.
Yeah, think about your thoughts. I feel like I'm Yogi Berrying up this show. Think about your thoughts.
That's pretty insightful.
Yeah, thank you.
It's good stuff.
I don't know why I sounded like a bear there. Thank you.
Thank you.
That's
we
Scooby-Doo.
know
No
why.
idea
You're
why.
Yeah, that's Scooby-Doo. Yeah,
Hanna-Barbera for sure.
Definitely Hanna-Barbera. All the voices sounded the same, right? They were all the same people.
They're all same people.
Yeah.
Yeah.
There was a gray dog in Scooby-Doo that I don't know, like Scooby-Doo's cousin or something, if anyone knows. Not Scrappy.
Scrappy.
Yeah.
Scrappy. Okay.
No, Scrappy
no.
was the little one, but
No,
there
no.
was like a gray, hickish type cousin.
He was like his cousin or something. I know what you're talking about.
Thank
I know
you.
what you're talking about.
If anyone can find that dog's name, that'd be fantastic.
I'll get right on it.
Thanks. So anyway, like what if we bought every IPO that comes out every year? So like you take $100 or $1,000, and for every IPO that comes out, you just buy. That's your allotment, whether it's $100, $500, or $1,000. You buy it. But and someone would say, Tim, that's ludicrous because like 90% of these things are going to go to zero, or they're going to merge, they're going to be worth nothing. But then I thought, but that's what startup investing is. So startup investing, if you're not familiar at home, if you're an angel investor or really an angel investor or a seed round investor, maybe not so much a VC. If you're a VC, you're doing Series A, Series B, you can still lose all your money. But an angel or a seed round investor, they go in with the knowledge that, if they're going to make 20 investments, 10 of them are just going to fail right off the bat. 3 or 4 of them might hit a double, you might hit a single, might hit a double. And the rest, they've got to make their money. That special 4 investments that are left, those are the ones that they've got to really make their money on, make their return on. And they don't know because these things, these businesses that they're investing in, they don't have any fundamentals oftentimes, or they're just small fundamental data, meaning small sales data, or they're investing in what's known as a minimal viable product or an MVP. And then, well, that's what a SPAC is. Like I'm talking with Hunter, and I'm like, Hunter, how do we? Because this question here of what do you think of PSTH? Now, Cody's asking before the deal with Universal. Like Cody's asking now that they have a deal with Universal, but you don't know who the SPAC is talking to, like who they're going to merge with. You don't know anything. SPACs do not have fun. They come public at $10 a share, and there's nothing behind them. You're betting on the management team, and that could be good or it could be bad. That's a crapshoot too. So that's what got me in the mindset of startup mentality. Like, well, this is like investing in a startup, and like, how do you increase your odds? You just buy them all, and the ones that hit because Hunter and I were talking about like, well, how do you differentiate between finding a DraftKings or when it came public, or a Desktop Metal when it came public, or was it Butterfly? Hunter, which was the one?
Livongo was a big
LVGO.
Yeah. Like, thank you. I appreciate that for the if you can think of any others, like how do you find those that when the deals are announced, people are like, I can't wait to get more of this. Now they've pulled back, but we're thinking long term here. You're just going to buy them all. Because if you had the opportunity, and I'm going to cherry pick, and I'm totally going to cherry pick here, opportunity to put $100 into Amazon, or when it came public at $18 a share, or $100 in Home Depot. We're going to go over this here in a second. But all of this came about from this morning conversation with Hunter, and I thought it was really interesting. But before we do that, Hunter, what are your thoughts on PSTH? Well, how do you pronounce the name of the actual SPAC itself?
That is
thank you.
Persian squared. I don't know if it's Tontine. I don't know.
Yeah, it's a weird name. I always want to call it poutine. Is that the French fry dish from Canada? Yeah.
Oh, it's really, they have it here in Jacksonville at a high-end barbecue place, top notch.
Nice, good stuff.
So give me your thoughts on let me pull it up, instead of just not looking at it. PSTH. Okay, Hunter, tell me what you got, brother.
Well, I mean, it's the one unique thing is the fact that it's not necessarily just going to be they're buying company X and that's it. Apparently, they're leaving room to acquire small pieces, but yet still substantial and influential in regards to the companies they acquire. But it's not just a one and done like a Blink Charging, a DraftKings, whatever. So it is a little bit unique in that aspect. But it looks like a lot of the SPACs do. You're still probably down 30, 40, 50% from highs. But I mean, Tim, actually pull up SPAK, and this is a SPAC ETF, and it's going to look pretty similar to a lot of the SPACs that are out there. They've gone on a decent run. You can see it's at the third ATR, and they've started to cool off a little bit. But my main thought on whether it's Bill Ackman or whoever, and I know these SPACs are relatively new. I don't think these people, these companies, hedge funds, whatever, I don't think they would be doing these SPACs if it didn't behoove them, if it wasn't advantageous over an IPO or that type of thing. And that's something to think about is, what, and I don't know all the loopholes that it allows them to avoid. I don't know every detail of, the structure of all the deals. But it's interesting in the fact that it allows you to get exposure to, like you said, basically a startup, as opposed to buying it when it first goes public, as like a DoorDash or those types of names. So I don't know.
Can we pause there for 1 second? So that's interesting to me because I've said this before, and I'm really glad you triggered the thought because I didn't articulate it here in this show, that when you're buying a SPAC pre-merger, you're literally buying a startup. And you mentioned DoorDash and Airbnb. These companies that have come public through the traditional IPO process, or if they've done a direct listing, you're investing late in the game. Like if you look at, let's look at Dash, right? We mentioned Dash.
Yeah.
Coin. Thank Coin. Coin is now self-serving in this regard, but like Coin has done nothing but go down. And so you're getting something, I don't know if it's, I don't want to use the word exciting, but you're getting in on the ground floor of a SPAC, whereas what Coin is, what Dash is, what Airbnb is. It doesn't mean they're not going to go higher eventually, but you're not getting the deal that the startup investors had. That going back to why would somebody be an angel investor if 90% of their bets are going to lose money? Because the ones that hit, like when you find an Uber, it's set. You take your $25,000 bet on Uber, and before you know it, Bob's your uncle. You've got a $50 million winner. Like it's and these things don't. I mean, to think that you're going to find an Uber, but you're looking for $1 billion type ideas, $1 billion companies, and you're looking to find them before they become that. So when you it's not so much with PSTH. Like what you're getting, PSTH. You're getting Universal. You know what their catalog of music is. Like I don't know what's transformative there, BLNK. But when you're looking at Blink Charging, Is Blink charging the future?
Yeah, look at CHPT, Tim. It's just the peer to Blink. Both of those look really similar.
Is
two
that
of the better looking ones?
Yeah, like is that who's going to line all the gas stations in America? Like when they remove an island of pumps, is it going to be ChargePoint or Blink Charging that's doing it, or are property rental, not property rental, but like when you see a Target or a shopping center, the people that own those properties, are they going to start putting in Blink charge points, and you can start charging for the charging, right?
Sure.
I am a hit today with words.
Yes.
But you can, you can do the equivalent math of what it costs per fill up of electricity, charge that rate, and give people a whole bank of chargers while they go into Target and stuff. Like, is the gas station going to be outmoded, and we're going to go to different areas where we would never think to fuel up like a fueled? God, I'm really in fuego today here.
On it.
Yeah, not even trying is the sad part. Fueled by ChargePoint and Blink. Is that the future? And that's the whole thing that angel investing and seed investors do. They're betting on ideas and teams, not so much betting on a sure thing is like when you're Series B or C and your vision fund coming in trying to get all the early investors out by buying them out. But SPAC investing is startup investing, and I think people never realized that when they started buying all these different SPACs like CCIV, right? Sure. Like, hey, which one's going on? Lordstown. What's the ticker? Is it Ride? RIDE?
Ride.
Yeah. So
it
this
had
is
some big days a week or two ago.
Yeah, and Ride actually came out this week and said they're having trouble maybe being an ongoing concern, which in layman's terms means they might go bankrupt. The cost of production is too high.
We can't start production is a problem.
Yeah. we took all your money, but here's the thing: we spent it on office chairs. Doesn't I mean?
This beautiful plant, plant.
Yeah.
Don't produce any cars in it.
No, we're not making anything. But what we do is we take all the plug power vehicles and we drive them up and down this beautiful plant. Again, not paying. We got tax incentives to come here.
That's right.
We do not have enough money. Who's what's the other startup? The one Friskers. What's the ticker for Frisker? They've come public again.
What is that one?
Yeah, that guy lost. He lost in the Obama era giveaway with a solar vehicle, like electric and solar power. Oh, they were just giving money hand over fist.
Oh, just handing it out.
Just handing
coffee
it out.
in the lobby, like just the best. Yeah, anybody can walk.
FSR is Fisker.
FSR. What's that do? Well, shocking. That's actually don't call it a comeback from 8.
Heyo.
It's 1855 here, up 5% today. So like you're investing in the future. That's what seed and angel investors do. But what they've done, without having to be an accredited investor, they've democratized it, and they're letting you buy into these future of work, future idea type companies, and that's through the SPAC process. What else you got, Hunter? You got some other thoughts on leadership or how you can maybe potentially find good ideas?
I got a little game for us first. I found this article, right? Top 10 performing stocks or performing SPACs of 2020.
All right.
And so let's run through them real quick and just see where they are now.
Yeah, let's do it.
Number 1 is QS, QuantumScape. Was up 1,200% or so last year. Now from 132 all the way down to 27.
That is
so pretty brutal.
That is absolutely brutal. That is. You know what? And I think this is really good because I'm about to present when I'm done. When Hunter's done here, I will present the Yogi Bear outlook, like all roses and picnic baskets. Like it's all good.
Nice.
Yeah, but this is reality right here.
Great.
Go ahead, Hunter. What you got?
All right, number 2 is DraftKings, which is going to look better.
That's a real company.
It's come back. Yeah, Well, I mean, QuantumScape has no revenue. Yeah.
See, that's
an idea.
I'll tell you what. Will you do me a favor? Will you say revenue or no revenue when you? So QuantumScape. So this is the difference between revenue and no revenue. And revenue means you're a real company. Like funny you were talking about revenue, and then you said, and then Alex said about cutting boards. We were talking about product market fit before the show started, and product market fit is very simply that a group of people love what you do, and they're willing to pay you for it. Like, that's huge.
It's a hard thing to come by nowadays.
Yeah, because there's freemium models, and freemium models are really tough. Like, you get, you can say you have product market fit when you're giving the product away because, free is good for everybody, right?
Of course.
But, but it's even worse, by the way, if it's free and they don't use it. They just signed up for a trial, whatever. But what does QuantumScape do, Hunter? And I'm sorry to put you on the spot if you don't know.
Battery technology company. You're supposed to be extremely innovative, but it's almost like NKLA. It's more of a concept right now, and 2 or 3 years from now, it might be very legitimate. But
that's fascinating.
Who knows, right?
And so here's the thing about
they have a partnership with one of the big
Volkswagen. I think
they have a big well, that hasn't resulted in any revenue for them, oddly.
Is that I don't know anything about the deal with Volkswagen, but what's interesting about, by the way, what's the ticker symbol for Volkswagen? It's like 4 tickers, right? 5 letters.
It's weird, yeah.
Yeah, it's a weird one.
VWAGY.
Thank you.
Yeah. Which they went on a big run.
Yeah.
Was that last fall, Don, where they had that big rally? Yeah.
But
March they had a big squeeze too.
Yep.
That's what I'm thinking of.
Better looking chart than old QuantumScape. And if the deal had revenue, or would get them to break even, or even somewhere close, I would think that QuantumScape would be higher. That's just a thought on my part. But revenue is absolutely important. You could be losing money, but are people paying you for the product? Give me another one, Hunter. What you got?
Okay. This is number. I'm not going to go through every single one of them, but CHPT, we already pulled it up. And believe it or not, I actually saw one of these at Larry's Giant Subs yesterday. My very first charge point charging system I've ever witnessed. But that one's holding up a little better. I mean, it's still come back a lot, but in regards to moving averages, it looks a lot better than QuantumScape does. And they actually have revenue. They have basically around 40 million in revenue over the last 4 quarters, or each of the last 4 quarters, so 160 roughly. So this is a little bit more legitimate. They're still losing money, but it's not just an idea. They actually have revenue.
That's
these charge. Can I ask a question there? These charging stations, do they have a universal adapter for them, or can you charge any car at a charge point? Or
that's a good question. I would imagine yes.
Do you mean
because it would be a disadvantage not to?
Is there not a universal charging? Like, it's not, every model is different, Don?
Does Apple make these things?
Is that true?
I don't know. Like, I'm wondering, Tesla, would Tesla allow other electric vehicles to be charged at a Tesla-made charging point?
If they were,
I think they're going to charge a membership, right? Where they have to pay to use them, right?
Is that Tesla or is that ChargePoint?
Last night, I watched Elon Musk present, and he said that there's now 25,000 supercharge stations that Tesla has built. So they
the supercharged ones charge a lot quicker than the quote unquote normal ones, and I think that's what he was going to charge the membership for.
Is QuantumScape battery swap? Is that what they're doing? I think QuantumScape. I think it's battery.
That's what Neo's doing. Neo's developing this where you pull in, and this like platform comes underneath the car and slides underneath and takes the battery out and puts a new one in.
Wait till these people.
Really?
Yeah. Wait till these people who, like, when you pull up right now, because it's so hit or miss, like it's just free electrical charging.
Yeah.
Like when you pull up to the Macy's, I parked next to one of these things and it's just free.
Yeah.
And I'm like, this is not going to be this way. It almost feels like the journalism model of the early 2000s, where everything was free and then you realize we can't give it away and we got to start charging. And like 7-Eleven is going to put in a whole bunch of electrical charging stations at their stores, but they're figuring out how to charge customers.
You got it. Yeah. Right.
Yeah. Like there's going to come a point, because so much money is made through gasoline tax for local and federal, that on your home electricity bill, and I predict that this will happen within the next 3 to 4 years, on your home electricity bill, there'll be a new surcharge added, and it'll be to replace the revenue lost from gasoline tax.
I believe that.
Mm-hmm.
Yeah.
Well, doesn't the state, if you have solar panels, doesn't the state give you, don't you get paid for having that because your carbon,
you can sell it back
your
to
carbon
them
print
when you're not using it all.
Yeah.
So it depends on the state. Some of us are here in Texas, and here the way we do it is you have to pay a fee to send that power back to Reliant or whoever it is.
Oh, really?
Unless you have one of those sick Tesla batteries in your garage, like those big wall
just
batteries,
charge,
then you store your own power. But if you're sending power to them, you have to pay them. I mean, not as much as taking their power, but dude, come on. Yeah, like really? I'm generating my own solar power and I have to pay you to hold it for me? Like, yeah, it's
well, Tesla's got that ecosystem, so they seem to be ahead of everyone.
Yes, it depends on where you're at. That's the deal in Texas. I don't know everywhere else.
That's interesting.
It's weird, isn't it?
I'm sorry, Hunter. I threw you all off. Give me some more SPACs, brother.
Oh, I'm all good, man. All right, so I got one that's actually holding up pretty well, and then I've got one that has been destroyed over the last 3 or 4 months. Pull up IMVT. This is it's a biotech.
India Mike.
India Mike. I don't know what starts with V.
Is it B?
Vector.
Victor. Victor.
Victor. There you go.
And Tango.
Yeah.
Okay, gotcha.
This one's just kind of fallen off a cliff all the way back to $10.
Whoa! What do they? What do they?
Such a bad chart.
Wow! What do they do?
They are transforming the lives of patients with autoimmune disease. That's what
they are transforming the lives of shareholders from good to bad.
Yeah, it's true.
Yes, every day that you own this stock, your life is transformed in some little way. Wow! What a medicine.
Yeah.
Last one here, Tim. L Pro.
Okay.
It's Open Lending Corp. They actually have a pretty constructive chart going. This was number 10 on the top 10 performing SPACs of 2020.
Wow, they have revenue?
Yes, about similar to ChargePoint, a little over 100 million in the last 4 quarters.
That's real revenue. That last company, that biotech, they don't have any revenue, do they?
Let me double check, but I don't.
I mean, they got to be hurting. Yeah.
That seems that we have discovered a criteria for SPAC. Well,
no revenue.
But this is the thing. So if you've got a SPAC, right?
Yeah.
And it's not producing revenue, when the market swoons, these things get hit apparently far worse than SPACs with rev. But then going to my earlier point that, well, Tim, if you're buying all the SPACs, right, and you don't know who they're going to merge with, the moment you find out that it's not with a company that generates revenue, trail up your stop. I'm not saying get out.
Yeah.
I'm saying have a plan to trail up your stop and then honor it. Because, wow, what an eye-opener. Hunter, this is Hunter for an early morning call and then coming up with some good crack research. This is good.
Yeah.
I got some more too, not just on SPACs. I got an IPO comparison that might be a little surprising to everyone. But let me say this real quick first. It's one thing to not have profits as, a new company, a SPAC. It's another thing to not have revenue. If you don't have revenue, then you're really not buying a business. You're buying a concept and hoping that it works out, and there's times when it does. But you just essentially you have no proof of concept if there's no revenue because you don't know if people are going to buy it. You don't know if it's going to work. So which explains why a lot of those ones with no revenue are down so bad. But what I want to talk about on IPOs real quick, you already pulled up Coin, you pulled up Dash. Both of those are down pretty bad from where they initially came public and started trading. Pull up ASO, which may be the most successful IPO I've seen in a long time. Just has trended higher the whole time. I think it IPO'd back in
right here in October,
yeah, and has not even
so
really
rare. Yeah. Didn't break the low of its IPO day. That is really rare.
What is Hibbert Sports? I'm sorry.
HIBB. Yeah,
I think that's
HIBB.
HIBB.
Looks pretty similar over the last
okay. I was just curious.
6 months or so.
And those are the only two public sports. Oh, DKS.
Yeah, I was about to say DKS.
Oh wow, that
not
is
as strong as those two.
No,
but
good ASO. Let's go back to it. I'm sorry.
Like ASO has only closed below the 50 twice in its existence, and pretty much it got right back above it and then moved higher. That was right before earnings back in March when it closed below the 50. So I mean, it's just really, really strong. I mean, I haven't seen that on an IPO in quite some time. Not for this long, anyway. The trend higher.
I'm going to pause you 1 second, real quick.
Yeah.
Because I just want to reinforce something that we talk about on the show a lot. For those at home that follow the ATR work, and you're like, well, that's a really good idea. When would I get into it? When do the probabilities present themselves the best? 1, 2, and 3. And so you're measuring average true range here, the mean, or the 21 exponential moving average, over the last 21 days here. ASO travels about $1.62. And you can see it's up 2.3% today at only 91 cents. So the average range of this stock is pretty big for its price point. But look, it honors the third ATR. When you get to the second and third ATR to the upside, you're getting extended away from the mean, and you open up the probabilities. They increase dramatically at the second ATR, exponentially higher at the third ATR, and you can see that this stock gets in the zone of the third ATR, and it wants to do what? It wants to kind of pull back. This is a 2 ATR, and it moves back. Well, here's another third ATR after earnings, and it comes back to the mean. And so, man, get this on a watch list, and when it gets somewhere, here's the mean. This is the mean right here, pardon me. Man, it's on the watch list now. I'm going to write it down. Great find.
Yeah, Tim, can I say one more thing real quick on ASO? Mm-hmm. And I don't, know for a fact that by any means that this is why it's performed well, but this was a very, very, very fairly priced IPO. I mean, this is a $3.8 billion company that's done over $3 billion in revenue in the last $3 billion in revenue. This is, their PE is a 7. So I mean, it's not like the coins and the dashes where there's a extremely high valuation relative to sales or to earnings. I mean, this is a company that is nicely profitable and is growing revenue. But I think that's part of it. It was priced very cheap and very fairly, and it's been rewarded for it.
Absolutely.
They timed their IPO pretty well too. With it being in
did.
Q4 of 2020, that was after the worst of COVID was behind us, and the reopening plays were starting to be where some money flowed into, and that they certainly benefited from that.
I think you're onto something there, Hunter,
they didn't pull back.
About fair pricing. And it's hard to say what fair pricing is. Coin was oversubscribed, right? It had all the hype, and it's just somebody paid $429 for this thing, $430. $429.54, and you're just down here now. What at $223? Just
what a good IPO was. I remember when I had my business, I used the Square device on my phone to charge clients, and they offered me I could get in pre-IPO with $1,000, and they IPO'd at $10 Square.
Oh, that's good. Weekly chart.
Yeah, and Square, I think Square was one of the best IPOs that I've seen in my trading career of 10 years, but that was a really good one. And one more recently that I'm watching now is EDR. That's the parent company to UFC. That chart's not bad, and it's holding up. That's one we could look at too, is EDR.
Oh, is that Ari Emanuel's Endeavor?
Endeavor. Endeavor.
Yeah, the parent company. They raised $510 million during that IPO. But the UFC, they talk about revenue.
Yeah.
That chart's not bad either. I'm surprised of how well and tight range it is.
So they're going to merge.
Roku is another one. Never broke the low of the IPO day.
See, that real companies
back
with
in 2017.
Real revenue. I think that's the differentiator. And the whole point of the show, Stock Nerds, isn't for us to always come off and look incredibly smart and pontificate from on high. I wanted to do this as, are there differentiating criteria that could help you? Because you don't know which SPACs are going to just absolutely take off. And it seems revenue, as the discussion evolves here, is really a differentiator. Would you, or even for the IPO, Like, is there an IPO that doesn't have? There's no IPO that doesn't have revenue. Is there? There can't be.
Not that I can think of in recent
I can't think one off the top of my head. But they're bringing out these SPACs with no revenue, which is an IPO unto itself. But I can't think of.
The big lesson, though, that I can share with our viewers on that IPO, the Square, if you have a stock that doubles, I doubled up on that, and I sold all of it. If it doubles, maybe don't sell all of it like I did. Because I look back, and maybe I should have kept a stub position. It would have been worth a lot more money today.
This is a really good transitioning point. So you wanted to be... Go ahead, I'm sorry.
There are definitely IPOs without revenue. There's a ton of biotechs out there that are...
thank you.
That's true.
Thank you so much. I appreciate that. Yeah, I wasn't even thinking of that space is so hit or miss, depending upon. That's a really tough space. Okay, you said something interesting there, Alex, about long-term views. So this whole discussion wasn't that long, but Hunter, was it like a 10-minute call? I think it sounded like I make it sound like we were just brainstorming, but it could have been more than a 10-minute call. And then from there, just started thinking about a longer term approach. And there's nobody who wouldn't want Amazon, right, from IPO to now. But Amazon, like 3 or 4 times, maybe 5 times, lost like 97% of its value. And so I kept thinking, well, what if there was, what if we just bought every year? You bought every IPO, like $100. If you could buy $100 worth, or whatever your allocation is, $100, $500, $1,000. And I know some of these things are coming public at more than, like DoorDash came public at 200. Is that right? Like when it was actually sold in the market.
I think so.
Yeah, it was high.
Right,
yeah. And so I get it. Look, this isn't perfect, but I just think there might be something that we're onto here, but it's really long term, and it really puts you in a startup investor type mentality, because some of these are just going to be worthless. But I'll present the good side here, and then I'm hoping somebody like Don or can give me the other part of this. But let me just start off with Amazon, the one I was talking about. And so you can have the research. You can just Google the what if questions. And so, what if you put $100 into Amazon? And this is Investopedia. So, and I've got it updated because this is as of May 2020. So $100, right, gets you $20. At $18 a share, gets you 20 shares. But then that turns into, with the splits, that turns into 45 shares, I believe. So you got 20 shares. Then it splits 2 times, 2 for 1. How many shares is this actually? Is this 45?
That's 5 shares there, Tim.
Oh, 5 shares.
100.
Thank you.
Yeah.
I think it's 45 shares at the end of it.
Okay.
I believe by the time you do the 3-for-1 split in 99, you've got 45 total shares.
2 for 1s. Yeah, it's close to there.
Okay. So now, what are those 40? So you put in, let's see, that's $100 investment.
Wow.
Yeah, no, watch this math. So let's pull up the Amazon chart here. It's okay. Someone has done the math. Have you done the math, Alex? On 100 shares,
it's over 100K.
It's 150K, and so at 45 shares, it's at just roughly this pricing right here, where I'm circling on your screen.
That is insane.
And that's the thing. So I just want to present this out here before some people out there, their eyes are like really big right now watching, going, oh my God, let's buy all the IPOs. And someone out there is just taking a dump all over this idea. So just but that's the truth. Like not everyone is going to be Amazon. You're going to have some, you know what? Let's do Twitter, right? Let's do Twitter. Not that. What if you put $5,000 into Twitter, right? And this is not as concise. Twitter IPOs, in 2013? And this is a whole bunch of gobbledygook. You can pause the video here, but $5,000 in Twitter, it gets you about 111 shares, according to the Motley Fool. And at current prices, you're now up about 32% because you're around $6,000 in price. So if you put 5,000 in, 111 shares. What's Twitter trading? What's Twitter? What's Twitter trading at right now? Please?
$60.
$60. What's the 111 shares times 60?
7,000.
Oh, 7,000. Pardon me. So that's a little bit more than 32%. So yeah, you're $2,000 ahead. You're still ahead, but you're not ahead like maybe you would be if you were aggressively investing and using the velocity of money throughout that time space. But we can do a couple more here, and it's certainly interesting to me.
And are they assuming that you're getting the IPO price and not the opening trade price on those calculations?
I don't know, and I don't want to pretend that I know. Great question. I don't know.
Well, what did said 5,000 bought 111 shares of Twitter?
Yeah, and here it is. Twitter.
That comes out to basically $45 a share.
Yeah. Here it is. Day one closed on. So on this Twitter example, day one closed at $44.90.
Yeah, Market Smith is showing the IPO price was $26 for Twitter.
So they used $44.90 in this calculation.
Okay. Yeah, it closed at $44.90 the first day.
Yeah.
Because the IPO price isn't indicative of where they open it up to the market. Sometimes there's a $20 gap up.
Oh no!
That makes it a much more valid study in what you're quoting, because only a few people get in pre-IPO at that price.
Yeah.
So they're assuming, at least from this Twitter example, they're assuming you bought it on the closing price of the first day of trading.
That makes it very valuable. And so, could you buy all the IPOs? And could you buy it? Could you just buy it all? And so I asked that question to the Google machine, and I came up, and Statista is something I use a lot. By the way, if you're into statistics and you're looking for information, Statista is the bee's knees. So I punched into the Google, how many IPOs are there a year? And this includes SPACs, because they're IPOs too. And so this article is from this January, just towards the end of January 2021. And in 2020, there were 407.
Wow.
And so if you just, now some of the IPOs, of course, are going to go, if you did $100 per allocation, like the Amazon example, the thing is, you don't know, nobody knows what's going to be the next Amazon. But at $100 bet, I mean, people are pissing this away at DraftKings and Penn, right? Or Barstool. They're doing the parlay, right? At $100, it's $100, and if 16 things happen that are really a statistical anomaly, I'm going to win big money. I don't think it's really any different, except this is years in the making. But there's something
that means at $100, you spent $40,700 just buying every IPO last year.
Yep,
so
exactly.
That's a quarter. That's a quarter of the 150K that your 100 would have turned into for Amazon. So
go ahead. I'm sorry.
I don't think we have the answer to whether or not you're profitable or not.
And I don't know all the IPOs. I mean, this is a bigger. This elicits a much greater study than what I gave it this morning. By far. Yeah, I'm pretty stoked to actually dive into this, because I don't know all the other IPOs from 1997 for Amazon. Which ones, who came public, and at what price, and where are they now? Where are they now? Did they get merged into something? It elicits definitely more time. But it's interesting to me that the first thing that stood out to me when I looked at this chart, I saw 99 and 2000, and I saw 2020, and now I don't have the bar here for 2021, but I can tell you that there were 200, I believe, Hunter, is this right? 220 SPACs in the first 3 months of this year. Is that right?
I think that's about accurate. Yeah.
Okay, so we'll just draw this bar, halfway up here, and that doesn't include any other IPOs. In the first 3 months, there were 220 SPACs, and I'm at 99 and 2000, and everybody knows what happened in 99 and 2000, right? .com implosion, right? And so, but look at the number of things that came to market at that time, and it didn't let up in 2000. 99 was the peak. It didn't let up in 2000. And I wonder, is this the same thing? Bring out the bear.
Quick. Summon the bear.
Summon the bear.
Now's the time.
My first thought was, oh my gosh, this is a repeat of this pattern.
Found him.
Yeah, it's a top, Mr. Ranger. It's a top.
Yeah. That's exactly what I thought. I'm like, wow, this is really like all these other years. Like now they got scared off. Look at this, 104. Like they're all scared of the terrorist attacks, of course, but they're all scared. We're in a recession. I'm trying to get my marker off of there so you can see it at home. But they're not these excessive numbers in the middle of this IPO sandwich. They're not 486 and 429, 20 years ago. They're not 407. And how many IPOs have there been? And can someone pull? Ironically enough, I do not have that number. Right now.
Well, I've got this. I was Googling.
Thank you.
As of by May, let's see when this was published before I read it. This is on June 11th, so it's pretty soon, or pretty recent. 300. I don't think that's right. Sorry. I'm trying to find the exact amount for 2021, but I think this is including all SPACs here. Not
well, it should, because SPACs are IPOs. SPACs are people too.
Let's see.
SPACs over feelings.
But I think this will make the point that if and this will all be hindsight. Like you can't take action on what we're talking about right now in regards to sum it all. But if we were to go into some kind of hibernation, you get what I did there, Zach?
Yeah.
Yeah. If the market does go into some hibernation, there's supply. What you're looking at is a graphical representation of supply. And when there's more supply than demand, price goes down. And so I'm curious to know how this all turns out. Oh my God. I think the next 6 months of the year are going to be fascinating in regards to everything that it's just a cataclysmic event going on right now between interest rates, bond prices, and supply. And the longer the market stays buoyant and strong, the more supply that's going to come into the market. I think DDI, the Chinese Uber, is going to come public here in the States this year, and that's going to be the biggest IPO ever, I believe. And so that's going to be a tremendous amount of supply, and it's just going to be really interesting. So we'll see where this goes. But then I thought the quintessential stock, it's probably for debate, but it's either Qualcomm or Cisco was the quintessential 90s stock and when it came public. And so here's if you just put $1,000 into Cisco's IPO, and if someone can do the math for me of where Cisco's trading at right now. So Cisco came priced at under $1. Seems like a bargain, right? Yeah, right. And so this is my whole point. Like, you just don't know which ones are going to be these massive revenue market capitalization companies. And so $1,000. How many shares of that? What's $1,000?
Does it tell you the exact IPO price there?
No, it doesn't. I'm looking real quick.
I'm just going to use 90 cents. That gets you about 1,100 shares or so.
So 1,100
times
shares.
55 today would be. So that's saying over 500,000. I'm showing 61,000, but that also might include splits and or dividends or something of the sort.
It's there. I don't know how many times Cisco is split, but and then look here in '87, Cisco received $2 million in funding from Sequoia Capital, VC, seed round, right there. And so I think. Oh, let's do one more. Can you buy all the IPOs? And there is an ETF based on this. And so let me show you this, which I think is fascinating too. And so IPO, I don't know what they buy though. That's the thing. I don't know it literally is IPO. It's Renaissance's IPO ETF. And so look at this return though. This came out in like 2012, I believe. It's a weekly chart. When's the first trade of this IPO ETF? Can someone give me that on the fly, please? I believe it's 20.
What's the ticker?
IPO. I believe it's 2013 or 2014.
1031-ish, 2013.
Okay. And so you come public at what, 20? And you're now trading 63? Is that 240, 250% return?
Do you want to know the top holdings, Tim?
I do. I want to know the percentage gain real quick. And then I want to know the top holdings. Who can do that real quick? Because it looks like.
So what are you looking at from like 2012?
Yeah, it looks like $20 to 63.
Oh, that's going to end up being
It's like 250%.
What, just 250? Yeah.
Yeah. That's not a bad. If you had a stock that gave you 250% for holding it, I don't think you're upset. So what are the top holdings?
So number 1, Zoom, 10%. 2, Uber, 8%. 3, CrowdStrike, 6.66. Pinterest, Peloton, Coinbase, Slack, Roblox, AVTR, Royalty Pharma, Datadog, Lyft. A lot of those that you would expect. Net, TXG, Dynatrace, Snowflake.
When does it rotate out of them? This would actually be an interesting interview. Like what
I might be able to see
what triggers the buy, and then what triggers the rotation. When does it stop being
Maybe it's IPO? A time thing.
Is it it's years, right? What does IBD use, Don? In terms of when does it stop being an IPO or a new America type stock?
I honestly don't know.
I wonder if it's 5 years. Because I started.
I think that's right.
Well, it used to be 5 years, I think, and then I remember seeing a stock that had been around for like 15 years in the New America and IBD, and I'm like, I went up to Gessel and I'm like, is this really new? And he gave me some answer like, well, if it's in the history of time, yes. I'm like, well, that's great.
Sure.
Yes, everything is new.
Yeah, right.
It's BC.
Some of these tickers that we've looked at today, and namely IPO and the SPAK, these are a great risk on, risk off indicator for the market, because these top just when growth stocks topped in mid-February, and
that's interesting.
Still quite a bit off their highs. Like a IPO dropped $20 from 77 in 3.5 weeks.
Yeah, that's a great. That is April. No, 215. Pardon me. Yeah, the growth stocks. That's a really great observation. Using these as a proxy for growth stock strength, because that's what IPOs are, right? They're gonna.
Yeah, absolutely. Yeah. It's a risk on, risk off thing.
Man, that's a really good observation. See, this is what we're doing. Yeah, go ahead, brother.
I got some information from the website here.
Yeah, give it to me.
For IPO, just on how it works. Mm-hmm. So this is the Renaissance IPO Index, reflects approximately the top 80% of newly public companies based on full market capitalization. Sizable IPOs are added on a fast entry basis, and the rest are added during scheduled quarterly reviews. Companies are removed 2 years after their initial trade date when they become seasoned equities.
2 years. They're using 2 years after they become seasoned equities.
And they've got this IPO index, which I think goes all the way back to June of 2009, before the ETF was inception. What was the inception on the ETF? Is it 2013?
Yeah, October 2013.
They've got a little chart on here comparing it to the S&P, and theirs is up about 650% from June 2009, and the S&P is up about 500%, 485. So, but the majority of that outperformance has come since the COVID bottom, like pretty much all of it. It actually underperformed the S&P 500 all the way until that the COVID bottom,
which
doubled.
Which is interesting.
Which is probably Zoom driving a lot of those gains.
Boy, there's a lot to unpack here. Let's stay on this for a second. One, when you say it's all Zoom, I'll work backwards as my mind is thinking. It doesn't take but 1 or 2 stocks a year to make your year. Isn't that a truism? That is absolutely so true.
Yeah, absolutely.
Yeah, well, and Peloton, Pinterest. I mean, they've got a lot of those had really, really massive runs in 2020.
The second thing I noticed is, Don, this is interesting, and I don't know how to study this more off the top of my head, but the bottom of IPO here is 316. And my initial thought was that is 2 weeks before Amazon bottomed in, I'm doing this from memory, Amazon bottomed in the end of March, because I remember buying it. The real market, like most of the market, didn't really bottom until the end of March, beginning that first week of April. And here this thing bottomed like 2 weeks before. I wonder if this is an early indicator. I don't know. But I find that aspect of this interesting. And then the third piece that Hunter mentioned was, what's the outperformance? 600% from 2009 to 500%?
650 versus 485. So
Now, how can they give you a quote from 2009 when it only started trading in 2013?
They have this. I guess they constructed their own IPO index based off of the same methodology.
How it would have traded is what and it's legal.
I will say this: it absolutely trailed from 11/1/2013.
Yeah.
All the way up till early 2020. It trailed basically the entire time until it took off with the COVID recovery and probably likely Zoom, as you mentioned.
And here's the thing that's interesting to me about that number, that 600 to 500%. It's disingenuous at first blush to me, because the way people do S&P 500 investing, typically if they're indexers, they might not be 100% in S&P, but they're indexing at 100%, meaning they've got some NASDAQ, they've got some S&P, they might have some industrials or some small caps in there, and maybe some bonds, but they're 100% invested all the time. You wouldn't take your 401k and put it all in IPO. IPO might have given you 600%, but what portion of your portfolio are you allocating to IPO? But that's true of any stock. When a new ETF, like Kathy, Kathy? Why do I want to call her? Honest to God, I'm not making this up. The only name that came into my head was Kathy Rigby, which I think is a gymnast from the 70s.
That is a gymnast from the 70s.
Yeah, I don't even know who that is. I couldn't think of Kathy Wood. What's her ARKK? Is that it?
Yep.
Like, it sounds great. Like, what'd she have, 500% last year? Is that right? Holy shit! Does her chart match? I'm on a weekly. She just matches IPO, doesn't she?
Well, I'm showing. So this is a way to compare it. IPO was up like 250% to the high.
Yeah.
Maybe closer to 275, and that's from the March COVID lows to the highs, which reflects that index, that IPO index. What was ARKK up from the COVID lows to the highs? 33 all the way to 160.
Can you do that?
So they outperformed.
What was IPO up again?
IPO was up about 260, 270% from the COVID lows all the way to the February highs. Sure. ARKK up about 500% from the COVID lows to the February highs.
That's interesting, because I've got 321 on my screen, but I'm not going to.
I'm looking at, so 33 up to 160. No, you're right. So 33.
I mean, that tightens it up a little bit. Kathy Wood is still winning, but why are we not putting the people that run this Renaissance IPO up on the shoulders? And boy, I'll tell you what, people love a cult of personality, don't they?
Oh yeah.
Like, Kathy Wood is revered, and they talk about this amazing return that she had last year, and it was amazing. But did we just identify? This was not the show I was planning to do, but sweet baby Jesus, like, she's tracking the IPO of Renaissance for all the talk.
Well, I mean, you could make a case to evaluate SPAC ETFs, IPO ETFs, and ARKK as just using those three as a way to gauge the sentiment for growth.
You can,
or highly speculative stocks.
Is Kathy Wood really that special?
Yeah, I would argue yes.
Why?
Everyone was hating Tesla when it was at 190 and 200, and she put a 10% position on it and the entire fund on it, and was way ahead of everyone and called it the price, and it hit the price. She said it was going to hit 3,500, and it did. So I think she's pretty ahead on innovation. And
I think she is too.
All right, I'm not going to argue. I don't.
Pretty brilliant. Yeah,
I don't have.
You can have your opinion. You're entitled to that.
I actually don't. I just look at the IPO chart, and I look at ARK, and I'm like, that's the same freaking chart.
It just happens to be I think it's a performance thing. Also, a lot of new names, new innovation. Tesla, for example, it's not like IPO was in Tesla. She happened to be 10%.
Oh, when did Tesla IPO? That's a great question.
IPO. There's no way IPO was in that.
Yeah.
Recently, Kathy was in Zoom. So. She was in DocuSign. So there is a good bit of overlap there too.
Yeah. Yeah, there's Tesla down here. What was Tesla's IPO price? $3 is the low I got. Did it come public in
I think it was
2010?
$33. I think it was around 30 at IPO.
Oh, split adjust. This is split adjusted 33. You're right. This is a split adjusted
Yeah.
price of $3. So, yep.
Okay.
Interesting.
Yeah, I mean, you make a good point though. Performance wise, it's very similar, and they do invest in the N in CanSlim is there on both of them.
Yeah.
The same
well,
chart.
and Kathy, her job is to invest in the N, and that just so happens to be a lot of companies that are just recently coming public, like Zoom or Coin or whatever. So it's just there is just overlap just by nature of what she does and the mandate of her funds.
And then just to put a button on this with this Pershing Square ETF, SPAC that's merging with Universal. So they're not using all the money, and that's the interesting thing here. Where what's the Hunter? What was the mission of Bill Ackman with this? He's going to invest in the best companies, not.
Yeah, I read I actually think I saw it on Twitter from maybe a trader or somebody I follow that was listening to a conference call, or maybe it was in a newsletter. I can't remember. But he basically said the objective of this entity, PSTH, is to not buy one substantial position in one company. They want to buy smaller pieces of a number of high quality companies.
Yeah,
which is a little different than what we've seen so far with SPACs. Is it's pretty much like, we're going to buy ChargePoint, or we're going to, it's been pretty much we're committed to this one company. And so this is kind of a little bit of a different scenario, and it'll be interesting to see how this plays out.
So it's not going to be a new ticker. He's under PSTH, or I don't know what the new ticker is going to be, but he's just going to bolt on like a conglomerate.
So let me read this article part here too. Yeah. So, and this is after it talks about the Universal Music thing. It says there's a sweetener for the deal for those patient PSTH investors. The SPAC will remain a publicly traded company with $1.5 billion of cash after the distribution of UMG shares, and will continue to seek a new business combination partner.
Okay. Well, that makes it seem more like a Berkshire Hathaway type situation.
I think he raised too much money and couldn't find a company for how much money he raised.
That's pretty interesting too. There's so much there
was a component in this article. Let me see if I can find this quote for you guys too.
Sure.
He
why you find that?
I think this is in relation to Universal. He said It says last month he told a Wall Street Journal interviewer, we're either going to get a transaction done in the short term, or we're going to be on to the next one. So that's kind of, I guess, where that was at, and now we know it's Universal.
Let's do one more, and then we'll transition to market stuff, more tangible, relevant stuff. But I am intrigued. I will tell you, stock nerds and market lovers, I am very intrigued by diving into this. All the IPOs from, I think, that 99 to current time frame. If you put 100, if 1% of a portfolio invested in them, or whatever the number is, you'll be priced out of some. But where are you at now? Like where are they now is a really good research project that I think I'm going to dive into. Let's do Netflix real quick, because Netflix was interesting to me. It's not easy to find all this right away. If there's a website, someone has a source that they're like, Tim, it's all right here. Like I am all ears. You send it to me. I'm really grateful. 2002 came public, $15 a share. Let's see. If you purchased $1,000 worth of stock, then how many shares do you have? 924 shares after 2 stock splits. What's the price right now? What's 924? Somebody, please. 924 times 489. 924 times 489.
452,000 roughly.
Okay, so $1,000 into almost $500,000 in what, 18 years?
Yeah. But that's really, you've got to do the study, and I bet you could export it into an Excel spreadsheet, and just kind of equal weight your exposure across, every IPO from year X, and just see based off current price where would those dollars be now. And the question is, if you buy 300 IPOs and 5 work, do they work enough to outweigh the losses on the other side? And obviously, if you get a Netflix, you get an Amazon, you get a Square, then there's a good chance that it does.
But what I think what this is talking, I think what I didn't start out with this to do this, but it came out as we're talking. Every cycle has a Tesla. Every cycle has an Amazon. Every cycle has a Cisco. I don't know what this cycle, I don't like this 2020, 2021 class of IPOs. I don't know which one's going to be that, but every class has one, right?
That's the $1 million question. $1 billion question.
Yeah. When did Facebook come public? Like Facebook came public in what, 2012?
If you find out, let me know.
Well, that's why you buy every one of them. Like Facebook,
yeah, but that's not realistic. I mean, that's just not going to happen.
I don't know. I think I think someone out there can put $100 towards every one of these. $40,000 allocation. I would do that. That's every year though. That's the problem, Don. And that's it's every year and it's cumulative.
And how far back did you need to go? And it's be a good doctoral thesis in finance for somebody, like you said.
Yeah, it's
Facebook 5/31/2012.
Yeah,
and 2012 they came public.
What was the price?
Wasn't it $38? Wasn't it $38 the IPO? Off the top of my head,
I don't know I don't know what the day one close was.
Yep, 38.
I think, yeah.
So, 30. $100 in the what's $100 in the Facebook hasn't split, has it?
No,
I don't.
That's
think
3
so.
shares. You have 3 shares, is what you have.
About 1,000% return. Right?
They haven't.
1,000%.
Facebook is 3 something, 330. So 900%, 800%, somewhere in there.
Yep. It all adds up. It's something I want to dive into because I think it's pretty interesting. Whether it's actionable or not, we will see. Let's start with Hunter. Hunter, you got a couple stocks you want to look at?
Yeah, I got really one sector in specific and a couple of names in there. I want to talk about solar real quick. And Tim, if you could pull up ENPH for me. That's Enphase. And I just want to mention these because there's 3 names in the space that are kind of making an interesting little setup here. ENPH poked its head above the 50 yesterday and then subsequently pushed through yesterday's high and got back above it after being slightly down this morning. And you've also got FSLR with a very similar pattern right there, sitting on top of a number of moving averages. The one thing about Enphase is it's like the 200, the 50, and the 21 are all within a couple of dollars each, right beside each other. And Enphase is above all 3 of those. The 100-day is the only one ahead of Enphase. And then you've also got SPWR, which looks relatively identical to the 2 we've already looked at. So these companies, this solar space, is trying to make a little bit of a move. And I would caution on SPWR, that's a short interest stock. So it has been part of the meme mania over the last little bit, and people have gotten a hold of it. So Enphase is in the S&P. It's a high quality company. Earnings are growing, profitability is there. But that group, and Tim, if you'll pull up QCLN.
Sure. I'm sorry. You said meme stock. Maybe you want to go look at AMC. I
figured it might lead you there.
That's a really interesting pennant forming on AMC right now in the daily chart. What stock? I'm sorry. Hunter, what'd you say?
QCLN. So you don't have to. I've talked about it before, but TAN is the strictly solar ETF that has nothing but solar stocks in it. And I just want to talk about the top holdings here in this ETF because it is the best looking between TAN and then ICLN is another clean energy ETF.
iClean.
Yeah, iClean. There you go.
iClean.
But you just really, you wouldn't expect these holdings here for QCLN. So I'm just going to list these off. Top 10 in QCLN. Number 1, NEO. Number 2, Tesla. Number 3 is ALB. Number 4, Enphase. Number 5, Plug Power. Number 6, ON Semiconductor. Number 7, Cree. 3, Brookfield Renewable. universal display solar edge. So it's actually a really diverse in regards to sector exposure, especially if you compare it to iClean or TAN. And it just so happens that it appears to be the best looking one for the time being.
Interesting. All right, man. Alex.
Last thing, real quick. I got one more. I got one more. I talked about it on my video yesterday. Apps Digital Turbine, a former leader that has tried to get something going. It's just sitting right below the 100-day here after it's pushed through the 50, held the 50-day yesterday after it retested. I'm watching this one to see if it can get through the 100-day and get through 74.80, which would be the most recent high about 3 days ago.
Okay. Awesomeness. Alex, what you got, brother?
I want to go over that Roblox trade I was talking about a couple weeks back.
Sure.
And it pretty much backfilled about 14% off those highs and 15% about to yesterday around 87, which coincides with a 21 EMA. And that's around that mean range that Tim was talking about right there. What's good about this is this potentially could be developing a second base. So if you miss that IPO base around that 75 pivot, 77 pivot, in a couple weeks time, when 6 weeks go by, that's usually the bases in the last few years have been about 6 weeks. Maybe this will give an opportunity and you can get in and maybe it breaks back out above 100 and we'll see where it goes from here. I'm still going to be using that 21 EMA as a good area to maybe potentially, protect my downside risk. Most leaders do hold that 21 EMA. So that was a good sign yesterday that it bounced off that and then it's up a little bit today. For me, that's the leading stock, at least in my portfolio. We do have a small position at Revere. It's a 2% size. So we'll potentially add if it does go up higher. It's kind of a tracker position for now to get a feel for it. And then moving forward, we'll see what happens. But our heavier position right now is CrowdStrike, and CrowdStrike has
one second. Can we stay on Roblox for 1 second? Do you mind? What am I doing on time? Am I okay on time?
Yeah, we got a few minutes.
Okay.
Yeah.
Real quick, what Alex just described there is really my favorite pattern or situation, and you can take this out on a daily chart or preferably a longer term chart, a weekly. But when you see this flat base and this is very small in nature here, but it's a consolidation. What most stocks do, leading stocks, they go up 15, 20%, and then they rebase. And then Alex mentioned a second stage base. They're continuation patterns. And if the story of the stock is still intact, and the story of if the market's still intact, it's not just falling apart, but the story of the stock is still intact, those patterns go on to do another 15 to 20%. And they're my favorite because Alex got the IPO base, or just timed together the front end of the show. Alex was a seed investor in Roblox. He bought the IPO base. And what I want to do is I like that. I know that the second stage base is typically a continuation pattern that might not be a cup shaped base, might not be the IPO base. It typically forms itself as a flat base or a 3 weeks tight. And those are my favorite patterns. And so absolutely something to watch here to see if it can just, trade within a range, consolidate the gains made here, and then march higher. By no means guarantee, but that's what I look for. And a really good eye there on Alex's part. What you got, Alex? So you said CrowdStrike, CWRD.
Yeah, actually, I'll let Don go over that. Don, you want to go over CrowdStrike? Because that was your idea.
Yeah, very, very similar to what Tim was mentioning about, where we like to buy things. And in this case, an undercut and a reclaim of the 21 bounced right off the 50-day on the 7th. So Monday, nice lower volume pullback for 2 days, and then a follow through. We've done 3 buys in this, and just really coming out of that little downtrend where it bounced, where it broke back out right there. Yeah, this is it's got some room to run till it gets up to the top of its prior base, which is a breakout would be above 251.28. Mildly extended from the 21 now, but not running away to the point that you got to be concerned about a harsh pullback.
And what else you got? I'll tell you what, we'll just transition, Don, right into what you're looking for next week. You've got the 21 over 21 video. Let me do that real quick if you don't mind, Don. Look, Revere Asset, there's a couple things I want to point out to you. Don's going to do the 21 over 21. I don't know, are you still doing, was it the Dirty 30? Was that
Dirty 30?
Dirty
Yeah,
30.
what we're doing is highlighting the ones that are recovering, because
Did
quite
you
a few
call
of them will not.
Did you call it the Dirty 30, or did I just make that up?
No, he
it's
called
the
it
Dirty
that.
30.
Thank you.
I started out to find 30 stocks that pulled back 30% from their high, and I ended up with 70 of them. And so I stuck with the name Dirty 30 because they all pulled back at least 30% from their February high.
So where
stocks were correcting.
Where you find Don talking about these dirty stocks, Daily Market Insight, RevereAsset.com, Daily Market Insight, and then there's two things. You'll find Don's video. He'll call it, Don, Jesus, it literally just left my head.
The Big Show is the Friday show.
Yeah, the Big Show, and then he'll do it with. He also has his Lunch and Learn webinar replay in there too. So if you missed Don's process improvements webinar, it's right tucked in under the Daily Market Insight. And then if you have questions on any of that stock, or anything that you see, or anything that you heard today, the easiest thing to do is just call 855-722-5932. That will get you to him, and he will answer the phone, him being America's fiduciary, Danny Stewart. But anyone, you can email right there. You can see our email addresses, and we're accessible, and we will absolutely positively get back to you as we empower individual investors across the globe. Keep going, Don.
So 8 of those 70 stocks in the Dirty 30 have now pulled back within 15% of their all-time highs, and that's the key area where you start to look for constructive entry points if you're following the O'Neill methodology. So I'll discuss the 8 standouts from the Dirty 30 list also, along with the 21 over 21 list.
Awesome. Is that all you got?
Yes, well, some weakening sectors this week. ITB really gave up the ghost, and along with a lot of builder stocks.
That is
something you brought up 2 weeks ago, Tim, and lowering of interest rates hasn't helped this trade.
That was the clue.
Restoration Hardware with a big gap up on volume yesterday, but it's actually near the low of its gap up, which is a negative sign. We do own this, and if it doesn't work, we'll just cut it. And basic materials and financials lagged this week. So those have been two. In fact, XLB and XLF have broken their 21-day exponential moving average.
Let's look at XLF real quick. And that what is interesting to me there is I think that was anticipatory, that PMI number on Thursday, which did come out hot. It filled everyone's dreams and desires of there's inflation out there, but the 10-year and interest rates didn't rise off of that. And for this to keep going higher and the banks to keep going higher, you need rates to go higher, and that is not happening right now. And if you talk to Danny believes, and I look at the 10-year today, Danny believes that why is the 10-year not lower? Meaning the 10-year should absolutely be selling off. Which would mean the TNX is in fact going higher. And you can see the TNX 10-year Treasury Index, which is at one. Look at this, Don. Just one. How you read this chart at home? 1.457. So it's absolutely come lower in the face of inflation. And if you talk to Danny believes that is the Fed. That is the clue. And I don't disagree with him here. The clue that the Fed is in there buying bonds, driving down rates, because they are waiting for the transitory effects to dissipate. But I don't think you're going to pay less for bacon. I don't think you're going to pay less for houses. I don't think it's transitory, but we can debate that at another time. Is that all you had, Don?
XLI also underperforming this week, breaking. So 3 of the 11 sectors breaking their 21. On the other hand, XLU reclaimed it, as well as XLV, probably on the back of the Biogen announcement about Alzheimer's. That really kind of kickstarted the entire healthcare sector.
Agree. Was that it?
Yep, that'll wrap it.
I got one last thing. I've been talking about this chart forever, this put-call ratio chart. And next week is options expiration week. It'll be a really interesting week. That typically is a choppy week, but it's not a sell-off week per se. But I think this chart is leading you, this put-call ratio chart. You can see the 10-day moving average really, I mean, even though the last couple of days it started to move higher. This to me has been a part of a topping process, and I think this put call ratio chart is part of that process, telling you that there are very few buyers left in the market. We need some sellers to come in to be the other side of this trade, and I wonder who's left to buy after options expiration week. And so I'm looking for a pullback. I don't know if it starts next week, but certainly after OPEX for the month. And by the way, the reason why I'm mentioning OPEX for the month, that's when the quarterly rebalance is going to happen. And a lot of people don't realize this. So they're not going to rebalance the Russell and all these other indexes on June 30th per se. They're going to try to do a lot of it when there's a tremendous amount of volume in the market space, and that's going to be on the days leading up to options expiration. So there's going to be rebalancing for the quarter, which ends on June 30th. And there's going to be just a ton of movement. And so I don't know I think next week is chop followed by a drop. And so with that, we'll talk to you next week on Your Money.